Good morning. Looks like we've got a nice attendance here this morning. So we'll kick off our webinar today, kind of getting into, the title we came up with was Optimizing High Net Worth Tax Planning. But maybe let's get into the intros and the background. So maybe I'll introduce myself and then I'll have my colleagues join. So big picture, I would imagine most of you that have been gracious enough to join us this morning are aware of the Schneider Wealth Management practice. For maybe those of you out there that are unaware, we're a $3 billion registered investment advisor. There's kind of two segments to our wealth management practice. We've got the high net worth or ultra high net worth side. That's predominantly going to be, the topics that we cover today. And then in addition, we also have a nice employer sponsored retirement practice that would focus on helping employers, not-for-profits, and kind of their retirement plan for their employees. So today, we're going to feature three advisors that spend all of their time on the high net worth side. So maybe I'll just go ahead and introduce myself. Dave Brinkman, I'm a partner in the group. In terms of maybe my background prior to joining the practice, I would have started out as a CPA with a Big Four firm in audit, then went to work as an equity analyst for an investment bank, and then I got into private wealth. And you'll kind of see some of those skills kind of come out today. So with that, maybe Matt, Kelly, would you two like to introduce yourself to the audience as well?
Yeah, I will go first. So thank you, Dave. It's Matt Biggs. I am a wealth manager here at Schneider Wealth Management. Been at the firm for about 7 years. Prior to that, 5 years, still doing, similar things as a financial advisor. The main difference for me was I was more in the broker dealer world. So, when we would talk taxes, the typical response would be, hey, that's a great question for your accountant or your CPA. So, coming to Schneider Downs 7 years ago, obviously being inside of a larger accounting practice, that was very awakening for me. So I've spent the last 7 years trying to sharpen some of my tax skills, and we'll get into some of those details today. Kelly?
Murphy. I've been with Schneider Downs since 2019, end of 2019. Prior experience, I've been in the financial service industry for about 20 years. Doing many different roles, but within Schneider Downs itself, I started off primarily in the retirement plan services to qualified employer plans and have transitioned over here to the ultra high net worth practice as of this year, helping with financial plan and cash flow planning for our clients with Dave and Matt.
So let's set the stage for what we're going to cover here in the next hour, and we'll go to the top of the hour. We may go over a little bit, but I imagine we'll probably be pretty tight on our marks. So kind of what we want to convey to the audience today and what we're going to walk you through is kind of four main concepts, which you can see here. First, in the last 2.5 decades, there's been an explosion in tax-deferred assets. Most of the participants on this call are very familiar with their 401k, or if they're a 403b or individual retirement account. You've really seen a tremendous amount of growth in tax-deferred assets. That leads to kind of the second piece of today's conversation, and it's a piece that we work with and interact with on a daily basis with our clients and prospects, because most people are trying to solve for, hey, I've done a really nice job of saving throughout my career, right? I maxed out my 401k, I got my company match, maybe I also a SEP, or I was a business owner, whatever the case is, you've accumulated some nice tax deferred assets. But now the next piece of the story is, hey, how do I convert that back to cash in a tax efficient manner? What are the things that I should be thinking about? And again, we're gonna build on these concepts. I'm kind of just giving you the lay of where we're gonna spend our hour. We'll hit on some kind of key terms, and then we'll also lay out kind of some milestones that are more age-based as you start to get closer to distribution mode. And we'll make some assumptions that, for most of our clients, target retirements maybe in the late 50s, early 60s. And so that's kind of where a lot of today's dialogue will be. And then finally, we'll wrap up today's conversation with, Matt, Kelly, and I will go through two real life kind of examples of, you know, how we work with clients, the questions clients are asking us in this topic, and kind of give you kind of some real life examples and, you know, how we might approach it, maybe some of the questions that we'll ask, and then ultimately maybe the advice that we would give an individual with those types of attributes. So this is kind of the premise of when I just alluded to the growth in tax deferred assets. What you can see here to maybe orient your eyes, we're starting from 2000 there on the left hand side all the way to 2025, and you can see kind of the various blocks. I'm going to draw your attention to the light blue and the dark blue, because those are individual retirement accounts or IRAs, as well as defined contribution plans, or think of, you know, the most popular one, 401k, again, if you're not for profit, a 403b. But what I see there is, and again, these are total US retirement assets. So we're talking trillions of dollars. Early 2000s, you're at about 5.5 trillion of defined contribution and individual retirement accounts. Now, if I could get your eyes to go all the way to the right-hand side, it's gone from 5.5 trillion to just shy of $30 trillion in defined contribution and individual retirement assets. That's a growth rate of about 6.5%, 7% per year over the last 25 years. And you compare that to the growth in total retirement assets, again, going on the left-hand side from an 11.5 trillion to 43 trillion, that's at about 5.5. So you're seeing tax deferred assets. It's the fastest growing space. And again, that's great. That's the accumulation piece. Where we're going to spend today's conversation is there's a lot of Americans out there trying to solve for how do I monetize this? How do I do this tax efficiently? Is there anything else I should be aware of? What other factors? And I apologize, I should have alluded to this at the beginning. Obviously, Schneider Downs as a whole is a professional services firms with tremendous qualifications on the audit, tax, consulting, wealth management side of things. Today's conversation is going to be more how we would talk to a client from a wealth management perspective. You'll see us get into some tax topics, but I you know, if the audience is expecting us to get into maybe as deep of a technical webinar as maybe you've seen from our tax department, I would say that's not what we're getting into today. This is probably more of from the lens of wealth management, how we think of tax planning and how we approach it with our clients, to maybe just kind of set the stage for the audience. So Kelly, as we kind of get into this, again, the first half of this conversation is we just want to arm people with a baseline of knowledge so that when we transition to the client examples, we're all kind of working from the same starting point. So Kelly, maybe why don't you take over and kind of talk through traditional Roth IRA?
As Dave alluded to, tax deferred accounts make up primary savings for most individuals. And these two accounts are where most individuals are most familiar with savings. So your traditional IRA, tax deferred, meaning you're waiting to pay the tax on the income that you've saved to a later date, typically in retirement. So we typically refer to a traditional IRA as always taxable, because any distributions coming from this account will be taxed at your ordinary income tax rate. Versus a Roth IRA, there's no upfront tax benefit. You're already paid the tax on the income as you contribute it to the account. But as long as you're taking qualified distributions, so a couple different rules, over age 59.5, and the account's been opened longer than 5 years, there's no tax on your distributions from the Roth IRA. So these are the two main vehicles that most individuals are using through their accumulation phase to save up for retirement. As we move into our qualified plans, so your employer plans, you're saving in your 401k or 403b. Some individuals, they're trying to decide which is the best vehicle for them to save in, the traditional 401k or the Roth 401k. To solve for those, some easy rules of thumb early in your career, so your 20s, your first job, you're not owing taxes every April. The Roth 401k or qualified plan is probably your better bet at that time. And as you progress through your career, getting closer to higher income rates where you want to defer some taxes, You may switch to the traditional 401k or do a combination of the two, mainly to help you with future tax diversification for future planning. And then once you hit closer to retirement, late 50s, early 60s, you may be just primarily in that traditional 401k to help alleviate some of your current tax liability.
Yeah, Kelly, I might add in because I think this is a nice visual, because this is a pretty typical question we'd receive from maybe an existing client. I've gotten this question in the last month. Hey, my son or daughter's starting their career. Should they do traditional versus Roth? And what I think is interesting, and again, kind of what we're going to tease out today, this decision is more of a tax decision than it is an investment decision. What you see along the left-hand side is, as your taxable income goes up, you see it, and we're making the assumption that as you accumulate more experience, skills, your taxable income kind of goes up correspondingly. So as you get later into your career, the pre-tax option for most of our clients that are going to be in those higher income brackets is generally where they want to live. And what you also see in that blended area, there's usually a period where it's like, look, it's a toss-up. It's not exactly a home run to be in the Roth. It's not a home run to be pre-tax. So maybe you do a blend of both. And then what you'll see later in this webinar is we start to get into the mid 60s to your 80s, and there's just more retirement planning that comes in. Matt's going to define RMDs here in a second, so we won't get too hung up on that. But this is a nice visual, because this is what every individual investor is dealing with in terms of accumulation mode and then ultimately into distribution mode. So Matt, now I'll maybe bring you up and have you again. We're just trying to kind of set the stage and build to some of these client examples, but maybe for the audience, let's define some of these key concepts that we're going to get into.
Yeah, so I'm going to hit on the first three that you see up there, and then I'll give it back to Dave for the next two. But what I would say about these 5 things are, these are 5 of the things inside of a wealth management, advisor's tool belt that can help not necessarily manipulate income, but can help us control taxable income levels. So, each individual is going to be different, but there's decision points to be made around all of these throughout the financial planning process. So if you want to hit Social Security, so I don't know that I necessarily need to explain what Social Security is to everyone. I think everyone is probably aware what exactly Social Security is. Here are the things that we consider, though, right? Most people, I think, tend to assume they're going to claim around full retirement age. The way that we would look at it is, there's a break-even point. So you can see it on the slide. At age 70, you're getting an 8% increase per year. So if you don't need the cash flow when you're 67, and usually the break-even point is, hey, if you wait till you're 70, you're going to break even in that 82 to 84 age range, meaning it made more sense for you to delay. And then that gives you 3 more years, if we're saying from 67 to 70, to do some additional tax planning. So this is again, where taxes kind of come to a wealth management crossing point. And it's not just as simple as, hey, I'm getting ready to claim for Social Security because I'm at full retirement age. Well, we should actually look at that and make sure that it still makes sense, not just from a cash flow standpoint, but from a tax planning standpoint as well. Dave, you want to go to the RMDs? So again, I assume most people are familiar with what RMDs are. That age keeps getting pushed back. So, currently it's age 73. It's going to be age 75 by 2033. And that's been changing over the last handful of years. So in general, what it is you've held on to this tax deferred asset so long that's pre-tax, and the IRS is saying, hey, you've held on to it for so long, it's time for Uncle Sam to get their cut back now. So they start forcing you to take an annual amount out of your pre-tax retirement accounts. So on the slide here, we show it's basically approximate to 4% of the account value, and continues to kind of slowly increase as you get older. The 10-year rule, it says for many beneficiaries under recent law. So let's say you inherit an IRA from a parent. The IRS is now saying, hey, you have 10 years to spend this down or withdraw this entire amount. So, going back to one of those first 3 or 4 slides, it's, there's a huge amount of tax deferred assets, specifically pre-tax, that continue to build. So if you were in a position where you inherit one of these, that's, you get the extra money, but that's also a big tax liability on your part. So how do we plan around all these things? And we'll get into some examples later. Roth conversions. So again, we'll hit on this a little bit later, but the basic concept is you have a large pre-tax account, and you can convert that pre-tax account into a Roth, which means it goes into the after-tax side. But the year that you do that conversion, you've got to be ready to pay ordinary income taxes on the dollar amount that you convert. So, there's a lot of rhetoric and kind of back and forth in our industry, and I'm sure in the tax industry as well, as far as, does this make sense? Is it actually worth it? I think if you look at the right-hand side, the way we would evaluate it is it typically works best in low tax bracket years. So when you're retired, if you haven't filed for Social Security yet, or your RMDs have not started at that point. I think the way that we would view it kind of generally across the board is, hey, right now, if you can trigger income at a 12% Fed tax bracket, we'd probably be excited about that. When it starts to get into that 22 to 24% range, and, I think a lot of it depends on the client situation. So again, I think, when we put some of this into context later, you'll see in client specific examples what exactly we mean by that. So there are some caveats to the Roth conversion. I don't want to go too into the weeds, because this is just things that you should be made aware of. I think the first two, the pro rata rule, I don't see that a ton, but it's just something that you should always be aware of. And if you're working with someone and you plan on a Roth conversion, you want to make sure you're understanding that rule and it's not going to affect you. The way that we would look at this, if I were to loop in that third bullet point on IRMA, we want to be cognizant as advisors when we are, making a recommendation to do a Roth conversion. Hey, what does that mean for your AGI, for your taxable income? And how does that not just affect what you're going to owe in taxes this year, but are there other effects to that? And that's where IRMA comes in, because if you're married filing joint and you go above that IRMA limit, well, now you're paying extra additional a month, and you need to factor that into the math on when you do that Roth conversion. So more of a, like I said, caveat is to things you should be considering when doing a conversion.
Yeah, maybe I'll 2-year lag. Generally speaking, when we've done some of the planning we're going to illustrate, I think we are periodically reminding clients, look, there's a 2-year lag to this. So you're going to call me in 2 years and be like, Matt, what'd you do to my Medicare premium? Right. So I think we're just trying to be more proactive and bring up. Now, that I don't know that IRMA in and of itself would preclude us from saying, hey, don't do a conversion. It's just things that in our experience is maybe a nuance or a detail that sometimes is overlooked. And given the lag, clients may even forget that we talked about it.
Yeah, it's, to your point, from a dollar perspective, it's probably not moving the needle a ton, but you do want to look at it when you're factoring in, hey, taxable income is going to go above here. That means 2 years from now, we're going to be paying more every month.
All right, so I'll jump back in here. We'll cover a couple more concepts, and then we'll kind of, ultimately get into real scenarios. So qualified charitable distribution. Again, the the target audience for this is somebody that's 70 and a half. And what you're doing is you're taking a distribution from your IRA, but you get to avoid recognizing ordinary income. And as long as it's going to a 501c3, the charity receives the funds free and clear. So, ultimately, qualified charitable distribution is a very effective strategy for someone that is charitably inclined, typically has excess assets, and is looking, for ways to maybe accomplish several things in a very tax efficient manner. And maybe I'll back up a second. We also know, and we've communicated this in kind of previous webinars, but about 50% of U.S. households give to charity on an annual basis. Now, the dollar amount I can't tell you, but 50% of U.S. households give annually. And then if you kind of more focus in on that affluent market or that high net worth market, those numbers jump to north of 80%. So a lot of times with our clients, they've been successful, they've been diligent savers, maybe they were a business owner, whatever it is, they've accumulated some nice assets, and they're generally charitably inclined. And so, again, once they get to 70 and a half, qualified charitable distribution is something that we would typically kind of be proactively bringing up to the extent, again, I would start with any client. You're doing this because you're charitably inclined. We're not doing it just for the tax benefit. Tax benefit's nice, but generally for most of our clients, it's because they are charitably inclined to begin with. I'll continue on that charitable theme. So a DAF, a donor advised fund. These are very flexible charitable giving vehicles that allow individuals to donate assets. You get the charitable deduction at the time the asset goes into the donor advised fund, not necessarily when the charity gets it. You can dole out that money over a subsequent period of years. And it's been very flexible and easy for clients. Generally speaking, when I'm working with a client that's charitably inclined, I will tell them, I'm trying to break you of writing checks. I'd rather we bunch up your charity because, now we're getting into itemized deductions and how might we best kind of stack your, deductions in a given year. Generally speaking, we would suggest that you fund these with appreciated securities. So again, just to level set for the audience, let's say you put $1,000 into an investment, it's worth $5,000. Well, let's forego, if I could fund this DAF in two ways. I can convert it back to cash, recognize $4,000 of capital gain, or I could give the whole appreciated securities and skip the capital gain altogether. The other thing you see here is you just got to be mindful of adjusted gross income limits. If you're giving cash, you can give up to 60% of AGI. If you're giving up, more capital gain type property, it's 30%. And then this is just the last kind of key point, as you could appreciate in a tax planning webinar. Really what this is just the 2025 income tax brackets. And obviously we're drawing your attention to those bottom three buckets. And again, we'll kind of illustrate how we think through this, but to Matt's point, those lower two buckets for most of our clients is home run planning. Can we fill up the 10 and 12% income brackets? Because that's about as good as it gets for most of our clients, unless they have some, operating loss or something that's going to offset a majority of their income. It's generally that 10 and 12% bracket. 22, it's going to depend on the client's circumstances. And honestly, Matt and I, at the back half of this, will walk through an example of a business owner where arguably the most effective tax bucket for them is probably going to be in the 24% bracket, kind of given the size of their assets and the associated income streams that those assets kick off. So the easy answer for us in this whole webinar is a lot of our guidance and suggestion is really going to have to be customized to you, the individual. What do you have going on? What's your balance sheet look like? How old are you? What are your other income streams? But, generically speaking, these bottom buckets are generally the buckets that we would look to be trying to capitalize on as much as possible for our clients. And then this, I alluded to kind of age earlier. I apologize to the audience. If I was more creative, I would have found a better way to present this. It's about as good as I could do. So if you got other ways, AI, generate an image for this. But what I'm trying to show you is the various kind of milestones that most of our clients, and again, I referenced our typical client is mid to late 50s to early 60s looking to retire. And, these are kind of some of the milestones that they're about to encounter. So Kelly did a nice job walking you through a traditional IRA and a Roth IRA. You can start to take money out of those accounts penalty free, right? So if you tap into them before 59 and a half, there's a penalty. After 59 and a half, they're penalty free. So there's one kind of level setting. Matt talked about Social Security. Social Security between 62 and 70. What's your claiming strategy? Does it make sense? Do you need the cash flow, right? We kind of talked about that. I talked about qualified charitables. You got to be 70 and a half before you're eligible. And I glossed over it, but you could give up to 108,000 via a QCD or a qualified charitable. And then Matt also talked about RMDs. Right now, RMDs start at age 73. I think here in the next 8 years, it starts to drift back to 75. But what we're showing the audience here is all these factors of, okay, what's your taxable income? What tax brackets are you in? Oh, by the way, how old are you? We're not asking these to put you in an uncomfortable situation. We're asking because all of those variables ultimately lead up to our ability to give you better advice. So, Kelly, I'm going to bring you back into the fold, and I'd like you to maybe walk through for the audience, our first example client.
Sure. So our first scenario here, Dave and I met with this individual, married with several adult children, although just one that has not fully launched, just starting college this year. This individual is a W-2 wage earner, but also has some self-employment income, late 50s, plans to retire pretty soon, within the next 5 years. So basic discussion on this person is a good accumulator. They've done well saving, but is a do-it-yourselfer. So they don't have a plan on decumulation. So distribution planning, cash flow planning, what is the most efficient way to get there in regards to creating their paycheck after retirement? So we want to help them solve for that. What accounts do I use? How do I create my paycheck in the most efficient tax manner, while also somewhat charitably inclined and maybe some inheritance planning for their children?
Yeah, and Kelly, I apologize. I missed my Law and Order disclaimer. The following story is fictional. It does not depict any actual person or event. I had AI look up the disclaimer for those Law and Order fans out there. I apologize. I should have led with that. This is all fictitious. All names and faces have been scrubbed for anonymity. So in all seriousness, though, this is a very realistic scenario for us, right? Again, we've led off this webinar with there is a lot of tax-deferred assets. People have done a nice job in accumulation mode, and now they got to solve for the distribution, and they want to do it as tax efficiently as possible. So this is a very real example of, it's not just our clients. I think it's most Americans in their late 50s, early 60s that are asking themselves, they're definitely asking themselves at a minimum the three questions we put up here. Hey, I got this window of time. I want to retire. What's it look like? Are my assets going to last? By the way, what account do I tap into first? If I tap into that account, what's the tax ramifications of that? So maybe, Kelly, as we continue on in this example, maybe let's walk them through in this particular instance, kind of, again, thus far in the webinar, we've said we typically lead with a lot of questions because we're trying to gather info and understanding. But now let's pivot to actually giving someone advice that's in this situation.
Sure. So individual's 59, I believe, this year. They want to retire age 63. They have some outside of their qualified accounts and savings, but they also have some self-employment income, primarily large portion, $1.5 million, in their IRAs, 401ks. How do we tap into that and keep them within those tax ranges that David highlighted earlier, that 10, 12, 22%? Order of operations. The self-employment income in combination of the Roth conversion. So Roth conversions kind of are the big flashy item I believe a lot of individuals look into to try to help them for future tax efficiency. So we're in our traditional IRAs, 401ks. We know that required minimum distributions are looming, tax at ordinary tax rates. Can we shift in these early retirement years? So at age 63, we're not claiming Social Security yet. So we're in a lower income tax rate, even with that self-employment income, no longer W-2 income, moving cash from that traditional IRA to a Roth IRA, which does not have that required minimum distribution. So we start to look at what makes sense to fill up that 12 to 22% tax bracket for this individual.
Yeah, and I'm going to jump around on you a little bit. So in this particular instance, this individual is at kind of the front end of this, right? They're in their late 50s. They're still working. So arguably this individual for the next, again, we'll say in this example, they're going to work another 5 years. They're at their highest tax brackets right now, right? They got a W-2 income job. They see themselves working there for another 5 years. Kelly mentioned there's some other outside income streams. You know, I don't, Kelly, you can disagree with me here, but, you know, the advice we gave this individual was, look, for the next 5 years, it's blocking and tackling. Max out your K plan, create as much tax deferral as you can. We might evaluate maybe setting up a donor advised account, maybe pre-funding because they were charitably inclined. Maybe we pre-fund the next 5 years of charitable contributions to maybe, you know, beef up your deductions. It's a concept called bunching. But you know, in this 5 year window here, it's kind of blocking and tackling planning. Would you agree?
Agreed, right. So in their lower income years, this individual doesn't need a lot of extra cash flow right in the early in retirement. So just opening their eyes to what possibilities they have in regards to future planning.
Yeah, let's play that story out. So now this individual gets to retirement. So now let's go down to the second bucket, right? The follow-up question we asked. All right, so you're retired. We don't have, now your income bracket's going to drop substantially from a tax perspective. By the way, you've got this other income stream. You know, what, are you going to need much cash flow? Kelly, if I recall, this individual said, no, not really. My spending is relatively low, and these other income streams from, you know, author and speaking engagements will more than take care of my cash flow needs. Is that accurate?
Correct. So basically no debt, mortgage is paid off. They've done quite well in regards to setting themselves up for somewhat of a stress-free retirement. I think the stress comes in, they're used to that W-2 income. So setting themselves up to, how do I replace that? Yep.
And then that led to, all right, now what's our plan for Social Security? And again, we're 5, 10, 15 years out, right? I mean, we're in our late 50s, but we're having these proactive planning conversations. And the advice was definitely don't file early, right? Why take that 30% haircut that Matt covered? You don't need the cash flow. And arguably, you probably want to defer Social Security as long as you can, right? I mean, that's how I recall that kind of the next piece to this conversation.
Right. So I think Social Security, a lot of folks have some anxiety around it. Do I take it now? You know, some headlines kind of give urgency to folks. This individual in particular, for their situation, they do have 6 adult children, and the spouse was a stay-at-home parent. Therefore, planning for Social Security, you're kind of thinking about, okay, the higher income earner, the highest benefit, spousal benefit, you're going to get 50%. So you're setting your spouse up. The increase, that age 70 delayed retirement credits, doesn't increase your spousal benefit, but the one estate planning caveat that I will throw in for this scenario is basically the survivor benefit. So if we're planning a little bit ahead for estate, the longer you wait, so that age 70 delayed retirement credits actually increases the survivor benefit. So this individual, we would recommend that they wait on their Social Security till age 70, especially if they don't need it. Gives us a little more wiggle room with the planning on the conversions to set themselves up for a little more tax planning for their lower RMDs. And then that survivor benefit will be higher for the spouse should that event arise and they need that extra cash flow in the future.
You've done a nice job of dancing with me so far. So I'm gonna keep on this example. So now, late 50s, work until early 60s, gonna defer Social Security. So now, in this particular instance, we're living in the 10 and 12% bucket, right? Until we file for Social Security.
Correct.
Would you say that's accurate?
Accurate, yes.
So now we start talking about Roth conversion, right? Because now, again, I alluded to, for most of our clients, and even in this individual's example, the 10 and 12% is about as good as it's going to get. Because once we file for Social Security and RMDs start kicking in, we're probably living, in this example, probably at the 22% bracket. So that's when these Roth conversions get much more interesting to us. Would you say that's kind of a fair of how that conversation went with that client?
Yes. So Roth conversions, take advantage of that, the gap years between retirement, Social Security, then RMDs, as well as it also plays into the second part of the estate planning topics that we did cover with this individual, that survivor benefit increase by waiting to age 70, as well as the Roth conversions. You know, Matt also alluded to the 10-year rule for inherited IRAs, beneficiary IRAs, moving some of the tax deferred dollars from your traditional retirement accounts into Roths help your beneficiaries in regards to that 10-year rule. So if they're taking it out of their traditional IRA, it's going to be ordinary income tax. They're forced to liquidate within 10 years. So that puts them in a short window for higher tax liability versus the Roth. They still got to take it out in 10 years, but they're not taxed.
And by doing those conversions, we're also, as the audience can see, you're also lowering your tax deferred balances. So you're also lowering future RMDs and you're lowering future ordinary income. Now, again, because Matt alluded to it, there's a lot of dialogue around Roth conversions. And, you know, really, I'll go back to the very first chart we put up. A Roth conversion is just as much tax planning as it is, you know, an investment management decision. So again, I caveat that the 10 and 12, yeah, a lot of times it works. You start drifting into 22, 24. I think you got to kind of crunch the numbers and kind of zoom out a little bit to see whether or not a Roth really would make sense. So maybe, Kelly, we've kind of touched on it, but, you know, maybe just as a recap, this was, again, names and it's all fictitious, right? But this is a real life example. This was real life conversations. And, you know, for the audience, this probably played out over 2 or 3 meetings, right? As we got more info and learned a little bit more about them.
Correct. So this person, high anxiety, do-it-yourselfer. After an in-person meeting, a couple other conversation, follow-up emails, they felt a lot more self-confident in regards to the job that they've done, getting themselves to the goal of retirement, as well as they have other options in their decumulation, their distribution phase, and the tax planning and wealth management part, how they work together to build their future for them, as well as their beneficiaries, their entire family that would inherit these accounts.
Well stated. All right, now we're going to move on to the second example. So Matt, maybe for the audience, let's compare and contrast this example versus the one that we just went through with Kelly and kind of lay the landscape for the audience on this example.
Yeah. So fundamentally different client examples, this compared to the prior. If you know, as we walk through this example, this client has waved goodbye to the 10 and 12% tax brackets. They are realistically never going to touch those again. So when we talked about Roth conversions in the beginning and, you know, your taxable income in the brackets, this would be one of those times where, hey, if you can pay at 22 and 24% in any given year, you're probably getting a little bit more excited about that. And Dave just put it up, 24%, you know, that's $394, $600 for clients filing jointly. So, and the example we get in and one of the graphs we're going to show, you can see we're gonna utilize every piece of that. So overview of the client. Married, filing jointly in their early 50s. Current net worth of 40 million. That's inclusive of business value. Has previously sold a portion of the business. Would like to fully exit the business over the next 3 to 5 years. In tax year 25, they're still going to have 300,000 in W-2 income. And there's actually in the scenario we run a transaction that happens in tax year 2025 of about $10 million. This client also has a large inherited IRA, so we'll loop that in as we go through this. So when we look at this, what are the things we're considering? The year of transaction tax planning, again, I'll get into that. Overall estate plan, multi-year planning, and tax efficient investment portfolio. So, I mentioned earlier is the crossroads where kind of tax and wealth management meet. I would say this example is a great example of the crossroads of where tax, wealth management, and estate planning all meet. And all of these things need to be talking to each other and need to be planned in conjunction with each other, because you can't have, one person doing one thing and, another service provider doing another. So if you want to flip to the next one, Dave, we'll keep going down the path.
It's all fictitious, but an example of what Matt just said, in this instance, there's two partners that own this business. The one partner did a Roth conversion while they still owned a majority of the business. And, they reached out to us for our thoughts, and we said we would not suggest that at 37% rates. By the way, if you guys are going to sell this business in the next couple of years, you're still really young. Again, we'll go back to that whole 59 and a half, 62 to 70, blah, blah, blah. Why don't you wait, sell the business, income tax brackets come down substantially, and then do the conversion? So I think it was a very good example, Matt, of what we're talking about, that if you don't have a very good understanding of investments, taxes, and estate planning, it gets hard to work with a client, at least, in my opinion, it gets hard to work with a client of this net worth unless you've got a pretty good understanding of those capabilities. And obviously the plug for Schneider Downs in this area, being part of a larger professional services firm, is most of the time it doesn't have to be in our wealth management practice. I can bring in a tax expert. I can bring in somebody that's, dedicated on the estate side. And really, we can put a team around you that really are experts in all those areas. So go ahead, Matt, continue from there.
Yeah. So additional planning. So we were working with this client before the business sold. So what are the things we were looking at? Portfolio implementation tailored to after-tax return. Great. What does that actually mean? I'll name two quick things because I know we don't want to dive too deep into investment strategy here, but tax loss harvesting. That's something in 2020, if you remember COVID, the S&P was down somewhere around 35% from peak to trough. So if you had new money put to work during that time frame or slightly before that time frame, there were lots of opportunities to realize losses and transfer those to your tax return. So basic understanding of tax loss harvesting. You own an S&P 500 fund. It goes down 20%. You sell it. You buy one that's just different enough. So you don't lose your market exposure, but you've just, taken that capital, that realized loss, and actually moved it to your tax return instead of keeping it as unrealized. One other example would be municipal bonds. So we built out a municipal bond account, and with individual bonds, 2022 was one of the worst bond years we've ever seen. The nice thing about having an individual municipal bond account with ladders, so you don't just hold one, you hold 15, 20, 25. Those held up very, very well relative to what other bonds did in 2022. Most, the Bloomberg US Ag, which is kind of the core fixed income index, was down around 13% that year. Our individual municipal bond portfolios were down maybe 6 or 7. So again, just small things that we are doing to try to create cash flow that's federal income tax free. That's the play on municipal bonds. optimize for inherited IRA. So again, how do you invest the IRA so that you have the least amount of tax liability you possibly can? You know, maybe you take on less risk, it grows at a slower pace. And why would you do that? Well, then that allows you to take on more risk somewhere else that's you've already paid taxes, like in a Roth. So take on a little less risk in the IRA. Your overall allocation is still the same or where you want it to be, but the inherited IRA grows a little bit slower. And there's more we could dive into there, but in the interest of time, I don't want to go too deep. Proactively discuss estate planning techniques, or it is future taxable estate. I think I'll hit that one, Dave, maybe on the conclusion slide. And then multi-year tax planning. We project current, future tax returns, and all of those are the income sources that we're looking at. So, you know, without further ado, unless you want to add something, we can get into the actual graph. So what this is looking at is taxable income per year, per calendar year. And on the right-hand side, you can see marginal tax bracket. So we've got 2025 all the way to 2033. The first thing that jumps out is 2025 is a pretty massive tax year, right? If you clear $10 million from the sale of a business, you're making 300, plus you have a portfolio kicking off, you know, interest, dividends, capital gains. That's going to create a 37% tax bracket, marginal tax bracket. So what are the things that we can actually do, or what are the triggers we can pull on to help minimize this tax bill as best we possibly can? So in this client example, the conversation is, well, you know, you're charitably inclined. Let's just assume you're donating $50,000 a year to various charities. Do we front end load, you know, I think Dave, you mentioned this earlier, front end load a donor advised fund for $500,000 or $1 million with appreciated securities, so you don't have to pay capital gains on the securities either, and you have just funded your next 5 to 10 years of charitable giving. That is one.
Sorry. Oh, by the way, we've done it with your tax return for the rest of your life, right? So we've done that gifting. We've bunched up your itemized deductions in the exact tax year you'd want to do that.
Yep, exactly. So aside from that, you know, there's other small things we can pull, but I would say for a big tax event like that, that is one of the major items we would always look at. So where does this go from here? Client retires at the end of this year. Let's say client said, you know what, I still know I have a small piece of equity, but I'm done. I'm going to let the business operate on its own. I'll maintain my equity, but I'm going to step away. So their income now goes to basically the portfolio, your retirement, your interest, dividends, and capital gains from your brokerage account. So what we want to do is utilize the 24% bracket to the best of our ability. So this is where I would say the dialogue, you can plan this at the beginning of the year, but the dialogue really comes in Q3 and Q4 when you're evaluating current year income. So in the assumption we did, we put that the client was going to have some investments in private real estate, which you know, can kick off some losses that are advantageous, and then private equity, same thing, right? There's a J curve in private equity investment. So typically in those initial couple of years, you're losing a little bit, and then it takes this curve all the way up, and that's when you see it outpace public markets. So what's advantageous about that from a tax standpoint, those losses are going to flow through. So we're assuming for the next few years, we should have some losses from those private investments. Now, again, we have to evaluate that kind of midway through the year and throughout the year to see how it's tracking. But the assumption would be by November, December, we're going to do a combination of two things in this scenario. One, how much of the inherited IRA income do we want to trigger this year? Two, how much Roth conversion would we like to do? And maybe it's one, maybe it's the other, maybe it's a combination of the two. But the point of it would be this client should always be filling up that 24% bracket. So in these projections that we did, their income is at 394, 599. Not exactly, obviously, but you want to use every last dollar at that marginal rate you possibly can.
And then maybe the other variable that you touched on briefly, but maybe give that audience a little bit more on the inherited IRA and the associated ordinary income tax strings with an asset like that. I know you talked about it earlier, but now let's make it real.
So let's put real numbers to it. Let's just say it's a $2 million inherited IRA. And we've already discussed the 10-year rule. So at a minimum, if you wanted to spread it out evenly, you have to take $200,000 per year of taxable income. And that's not factoring any growth, right? That's just a straight line calc. So in 2025, one of the conversations we had with this client was, look, it's a big tax year. You're going to have to write some big checks for your estimated payments. We already have this inherited IRA that you are going to have to withdraw over the next 10 years. And we need to trigger income from that inherited IRA to do that. So rather than writing a check, would you rather just do 100% federal withholding from the IRA? And let's say it's 100,000, 150,000. And that makes your quarterly estimates that much less because inherited IRA withholding is treated as pro rata. So we don't have to worry about the timing of that.
Yeah, you're really blowing through this fictional scenario here, because in this example, the buyer was private equity. There's distributions for taxes. So by doing the withholding from the inherited IRA, the client actually kept more of the cash flow in their pocket too. Was the other kind of variable to that.
Yep, I know we're getting close on time here, Dave. Yep. So you want to maybe flip to that? Yeah, thank you. So this basically summarizes some of the things we've talked about, but some of the things that I didn't hit on were the estate planning. So that's when the Roth comes back into the picture, because you can utilize the Roth as an estate planning tool, right? You do a Roth conversion. You're realistically, for a client like this, they are never going to touch their Roth dollars. They'll never need them. It's more of an estate planning play where that money can grow tax-free and tax deferred all the way until, the second spouse's death. And then the kids get that, income tax-free instead of receiving an inherited IRA traditional and having to pay taxes on, a large inherited IRA. If it's me and I'm inheriting the money, I'm choosing the Roth. The other thing, when we look at this client's net worth, this is where the estate planning comes in. They are at a level where we want to make sure we are utilizing the lifetime exemption. If this money keeps growing, there's certainly going to be an estate tax bill. So what can we do in this year, in the near future, to get some money outside of your estate, let it grow outside of your estate so that it grows outside of your estate? You just use some exemption, but now it's not growing inside the estate. So the sooner you do it, hypothetically, the less exemption you have to use. So that's, a conversation for today and an ongoing conversation with this client.
Yep, I think those are all very good points. So maybe I'll move to put a bow on this. I think we've kind of the summary here. And again, thank you to Matt and Kelly. I thought they did an excellent job kind of giving you a little bit more than just the bullet points that anybody could pull up in an AI-driven world, but kind of illustrating specifically how we're trying to get to know the individual, know their specific tax items, personal balance sheet, but ultimately we're probing for those types of details to give them much more customized advice that would be unique to them. So kind of in closing here, and it's a summary of what we've already presented, but, you know, having a plan for your tax deferred assets, and, you know, we all have them, right, with the growth in 401ks and deferred assets. And hopefully we've illustrated, we wouldn't say that's a 1-year plan. That's a decade and a half type multi-year planning and mapping it out. And again, to Matt's point, back half of every year, we revisit, dust it off. Does it look like we thought it would? Is there anything that's changed? Any significant taxable income up or down? Anything that we could take advantage of? The tools in our tool belt, right? It's interesting, I guess, to say that age is a tool, but it is, because you can see 59 and a half, that's when stuff starts to become more and more available to you. What are you going to do with Social Security? 10 and 12% brackets on the conversions. What's your plan for R&Ds? How might we, if you're charitably inclined, how might we best capitalize on that? Again, Matt kind of talked about it. We gave you 2 examples. In Kelly's example, really topping off the 10 and 12, I would say is very effective planning. In Matt's example, given the size of the client, the assets, there's only so much planning you can do here legally, right? I mean, there's only so much we can do if you've got assets of that nature. So you're probably more in the mid-20s and, you know, probably looking to top those off. And then Matt did a very nice job, but we didn't want to get too deep into the estate planning side of it. But really, I'll reiterate, and this is not a plug for Schneider Downs. This is just a plug for really the power of coordinated advice across your tax preparer, to your investment manager or financial advisor, and your estate plan. Those 3 don't need to be all at the same firm, but I would encourage you to make sure that they are aware of each other. And I will tell you the role that we typically play in clients, at least the ones that, you know, Matt, Kelly, and I work on together, we're generally kind of seen as the main point of contact. And then we, you know, facilitate with our colleagues on the tax and estate planning side and make sure the client gets served. I would encourage the audience to make sure that I mean, what I'm describing to you is a trusted advisor that's capable of kind of shepherding you along the way. Hopefully we've illustrated to you today, you know, taxes are a big part of kind of getting this all right. And then again, depending on the assets, the estate planning can be even a bigger piece of that overall. So maybe in closing, and again, we operate at a team level. I just thought I might make it easy for the audience. You can reach out to me. We're happy to have a follow-up conversation with you. You know, I would look to get other teammates involved. I'm just kind of keeping the follow-up easy by putting my name in there, but we work on a team-based environment. And then maybe the plug, if you've enjoyed today and enjoyed us kind of illustrating how we work with clients, the stuff we think about, you know, we're active on LinkedIn. That's predominantly our maybe most active social media page. And then, you know, if you'd like, subscribe to our monthly newsletter where we kind of package all the stuff that we do on a monthly basis and kind of make it digestible in a, you know, summarized format. So with that as a closing, as we come to the top of the hour, looks like we had, you know, 90+% of you hang in there for the full hour. So Matt, Kelly, I'm going to call the instant feedback that this was a well-done webinar. We didn't have people hit the exits too early. So with that, we'll conclude and appreciate everybody spending an hour with us today.
I do want to throw out there, I see a few questions about slides being available afterwards, and all attendees will get a copy of this recording in about 24 hours.
Yes, thank you, Kelly. Everyone will get an email. It will come from On24, but it will say thanks for attending our webinar, and that will contain a link to the on-demand version of this webinar. Also had a question about the PowerPoint slides. If you go to the right-hand side of your screen, there's a resources link. There should be a PDF copy of the PowerPoint slides there for you to double click and download. So I'm about to close out the webinar, but if you don't get to it, it will also be in that on-demand link that you can use in about 24 hours.
Yeah, and if you have any issues, just contact me and we'll make sure it gets resolved for you.
All right. Thank you, everyone.